what we're going to talk about today, 2-1 buy downs, because we're hearing a lot about those in the market. We're going to talk about the life alone buy down, which is what we've always done. It's discount points. You know, you look at some of these houses, the sellers still think they don't have to do anything with their house to sell it, but they still want top dollar. So what about a renovation loan? What about letting our buyers know they can go in and make this house theirs? And there's this special program I'm so excited to tell you about. It's called an FHA 203H. And believe it or not, it's a great loan. A lot of people are coming up to Georgia right now. We're going to talk about loan assumptions, which I know we've talked about that once before, but let's talk about that a little bit more. And then for that special buyer, what about a recast? Does anybody know what that is? So we're going to talk about a lot of different things. So let's get started. Okay, the first thing is a temporary buy down. For those of you that have been in the business for a while, I know that back in the 80s, we did a lot of these. And I know I just dated me, but it is what it is. So I actually had a buy down on my first house, and that's how I know how they work. And my rate at that time was 13.5. So the first year of my mortgage, I paid 11.5, the second year, 12.5, and the final year's 13.5. Well, what it does is it gives you the opportunity to get 2% lower in rate than what the current rate is. So this one, I used an example of 7%, okay? So what it would do is the first 12 months of the loan, you would get a rate of 5%. The second year, you would get 6%. And then for the life of the loan, it's 7%. It's all amortized over 30 years, just like a regular fixed rate loan. But it allows you to maybe get into the payment a little bit and not necessarily start with the highest payment, but maybe gradually get into it. Or let's say you're planning on where your job, you know, you'll be making more commission, you'll be making more income in the next few years. So you'd rather a lower payment that first year. It allows you to do that. A seller can pay the buy down cost. But I did on this calculation as I showed you. So at 5%, the principal and interest is $2147.29. Now I did this on a $500,000 house, putting 20% down, okay? The difference in the monthly payment from the first year to the third year is $513.92. Don't you think a buyer would like to know if they can pay that much less the first year and maybe build into this house as opposed to going straight up to the higher payment? The next year, when it goes to 6%, the payment difference is $263.01. So again, for 12 months, you're going to be paying that much less. So what you're essentially doing is paying the difference between the payments and what the final payment is, and you're paying that up front. So in this example, the 2-1 buy down, the cost to whoever's paying it, whether it be the buyer or the seller, is $9,323. But you look, if you have a seller that has a house listing and they say, hey, I'll buy a buy down, think about it this way. You're saving this to the buyer, and the buyer may go, hey, this is worth it to do this. So that's kind of how a 2-1 buy down works. I can't see if people have questions, Derek. So I'll just keep going, and then y'all can ask questions at the end. Do you want me to do that?
Yes. And if there is a question that comes through the chat, and you guys, if you have a question, please feel free to, you can unmute yourself. If you put it in the chat, I will relay that to Linda. But after Linda is finished, we will open the floor, and I know we'll have some questions then.
Okay. Sure. Okay. I didn't ask that ahead of time. So then I said, you know, I keep on hearing the word buy down so much right now. And so we want to understand that there's a difference between a temporary buy down and you're buying down your rate. Okay. Because you can also buy down your rate for the life of the loan, which is just discount points, just like we've always had. It's the same thing that's been around forever. But what you have to think about is what's going to better help the customer. So what I suggested to somebody is before you do a temporary buy down, look and see what's going to happen if you buy the rate down for the life loan and how much that costs you, how long you're planning on staying in the house, and which works out best for your plans. Because I may choose something different. If I'm only going to be there for 3 to 5 years, I may choose to do this. If I'm going to be there 30, I may want to buy the rate down to 6%, and it may cost the same amount of money. So I'd rather put the money towards buying it for the life of the loan as opposed to a temporary. So it's really about educating and making sure that you're working with a lender that's going to take the time to break out these numbers and let the buyer make the decision that's best for them and their family. Okay. So that's the difference between the two of those. And that's a big plus right now. Going into listings and things like that, it's a big plus to get sellers to understand that the buyers you know, they're a little bit afraid of these rates and things. So maybe we need to get the sellers to pay a little bit more closing cost and to help out a little bit now so that the buyers aren't feeling all of this on their own, because the market has changed. And I listen to a lot of realtors out there and they're all like, oh my gosh, my house is actually sitting for 2 days and it's not sold yet. And it's just a matter of also educating our sellers how the market's changing, but also knowing these ideas to give to our sellers and our buyers.
Right.
So
A couple
the
things,
next
Linda, on
thing,
that one real quick. I'll just kind of throw, excuse me, you guys, my voice is wanting to do, not work with me today, but you do need to qualify for the higher interest rate. And, you know, in this example, I love this. This is awesome. But like, let's just say like right now in the market that we're in, right? You know, you get a seller to agree to pay this because you're hopeful that the interest rate is going to come down, right, in a few years. So is it, I'm assuming it's possible that I could refinance before I ever even hit that highest interest rate?
absolutely. There's no prepayment penalty or anything like that on the loans nowadays. It's just like any other loan. It's just the rate has bought down temporarily. So you can refinance once the rates do get better. Everything I'm hearing is they don't know how long. At first they were saying by the end of the year. Now they're saying maybe next year or the year after. But as the rates do go down, they can refinance. So it's a great way too, if they think the market's going to get better in the next 3 years, to get, you know, to go on and refinance this out before it does go to the full interest rate. But thank you, Derek, so much for pointing out, because I did put that on there. They do have to qualify for the highest rate.
Yeah, I can see that being helpful, because if you are hopeful they're going to come down, and that is the sole reason why you're not buying right now, if you can go this route, then, you know, if it comes down, hey, I'll refinance. And if not, hey, if they go up, at least I've got, you know, what the current interest rate is, which is less than what it's going to be depending on what it goes up to.
Correct. Because unfortunately, if they don't go down, they could possibly go up. So at least it's locking them in at something that they know right now how to budget for it, and they will be able to prepare for it. Okay. So the next thing that I think is huge right now is renovation loans. There are so many different options in a renovation loan. But think about it this way, because sellers don't really want to do that much, letting your buyer know, hey, it's good that the seller didn't do anything to their home, because this way you can make it your home. You can put the colors you want. You can redo your kitchen. You can put in energy efficiency. You can do everything that you want to do. But if you don't do it with a renovation loan and you do it later, then you're going to be putting it on a credit card, or you're going to be putting on a home equity line. And all of those have higher rates than even the rates do for a regular loan right now. Because obviously, as y'all know, a mortgage is a little bit lower rate because it's a long-term rate. And that's what the mortgage companies are making money as long-term. You have a VA loan. You don't have to put any money down and you can do renovations on your house. How sweet is that? I don't have USDA on here. I didn't think about that, but USDA, if you know, you can do renovations on a USDA loan. You can do them on an FHA. FHA, you know, you always hear about a streamline 203K. You can only go up to 35,000 in repairs, but there's also a full 203K where you can do more. Conventional, you can add on to your house. You can put a whole second story on your house and build onto it. And maybe they decide, hey, this is the neighborhood I want, but this is an older home. Maybe it was built in the 50s. It's a small bungalow, but they need a lot more room for their family. Do a renovation loan. They can make it theirs, and they're in the neighborhood they want to be in.
Now,
so
I've got
this is the
question.
huh?
Oh, I'm sorry. Go
Well,
ahead.
I was just going to say, this is the way that, you know, I've got several customers now that are just on the fence because they want a certain neighborhood, but they're not finding that particular house. This is a way to make it their house.
I've got one question in the chat, and then I've got one question too.
Okay.
But Rena Nichols, one of our brokers on staff, asks, how much does one have to put down for a conventional renovation loan?
Depending on which one they're doing, they can put as little as 5% down. Now, what limits you is what the appraised value is going to be after repairs. And as we all worry about and we think about, is some of the repairs that they're doing that are cosmetic are not going to add value. Some of the things are going to add value. I did one a couple of years ago where they added a second story on an older home that her parents had lived in, for 50 years. And it was a neighborhood that was growing, and they were able to build it up to the neighborhood. You think down in Buckhead and places like that, where you have a home that's never been touched, and then you have a home next door that's a McMansion. Well, you've got the comps around it to support the things that you're doing to the home, but it doesn't really add value when you're doing, like I said, just painting, just changing carpet, just doing things like that. So that's why they say like 35,000. Okay.
Right. Talking about value though, can you speak any about the appraisals? Because you have a property that you've got, you have a vision for, you're going to improve it. But the current value is going to be less. I'm assuming that you guys will be okay with that. Is there anything different about that appraisal process for
It is.
a renovation?
It is very different. So when you do a renovation loan, the first thing you're going to do, obviously, is get a contractor to find out what it's going to cost and get a bid. We don't even order an appraisal till that bid is done, because we want to see what type of work they're doing on the home, but not only that, but the quality. What are you putting in? Are you putting in extra molding? Are you putting in all the high grade stuff? Are you putting in Formica? Or are you putting in, up to date, nice things? I don't know how I got Formica in my head, by the way. But anyway, so it has a lot to do with that, but the appraiser knows that stuff ahead of time. So when they give you the value, they're giving you an as-is value as it is right now. Now it has to appraise at least for the amount you're paying for the house. Okay. Just like any other appraisal, but it also has the value of what am I going to get on this house once all these repairs are done? And that's why it's really the detailed bid that you get from a contractor is very, very important, because they have to show the type of work that they're going to be doing and how much they're going to be doing in order to make sure that that appraiser sees everything that's going to be done to help that value.
That's really good advice, because that's something that, just in general, you wouldn't think about. And there are companies out there like Punch List USA who can do quotes and that kind of thing. But that's a really good info.
Well, I've had some where you've had to, like the last one I did, they had to go get additional quotes, and they had to get somebody else to do it because the person wasn't giving them really details of what they needed to know. And a lot of these contractors don't want to do that kind of stuff. That's not their thing. Their thing is going out and hammering a nail and making things look beautiful as far as the wood and the work, but doing the paperwork also has to be done so that we can make sure that they know what is going to happen with this house. This is something that popped up on my emails a few weeks ago, and I thought it was the coolest thing in the world. And unfortunately, I mean, it sounds really bad, but recently there was a very bad hurricane in Florida, and a lot of people have been displaced out of their homes. And it's going to take a long time for these homes to be rebuilt. Well, this program is called a 203H. And what it does is that if somebody happened to have been living in Florida, they do not have to buy in Florida again. And a lot of people are going to Georgia. A lot of people will say, I'm not doing this again. You think about the devastation. I'm not going through this, and I'm not going to sit here for a year waiting for insurance to figure out what's going to happen to my house. So what this program does is anybody that happened to have been in a presidentially declared major disaster, so anywhere where it was in Florida, and we have certain areas that were declared a disaster, and if they owned a home or if they were just renting in that area, and if they decided to come up to Georgia and buy a house, they could buy a house with 100% financing, no money down. That is, to me, is just amazing. Now, we do have to get a HUD inspector to inspect the house that they were in previously to make sure that it is not inhabitable. But let's say somebody owned a home in that area and they're trying to buy a house in Georgia, and that home is under insurance. We can validate that and not have to even count that payment against them in their debt to income ratios. But they can come up here and they can buy a house with not putting any money down at all.
Oh,
minimum credit score 600. Isn't that crazy? I know. I've been telling everybody I know, because people are moving, to other places in Florida. They're moving to Georgia. They're moving to Alabama. They're like, I'm not going through this again. And I don't know that I would go through it again if as bad as it was. And you just never know. And, people may be relocating. So I just wanted to bring this to your attention, because it may be something that you run into a customer that is in this situation, and it's a little bit unique and you don't hear about it.
Yeah. One question did pop up just as soon as I said I didn't have any, which is awesome, from Barbara. And this is a great question, but she says, does the contractor need to be assigned or approved by the bank? Talking about
yes, absolutely. And they have to be licensed. They have to have their insurance. It is a process, but once they get that, that's one of the first things we do also is to make sure that, now some of them, if they've worked with Fairway before, they're already on the approved list. But if they have not, then we'll get
Right.
insurance, we'll get their license and everything from them, and we'll put them through a approval system.
Right.
Because we want to make sure that they're going to do the work to the satisfaction of the client, but also of us to make sure it is a good, well-built addition or changes to the home. I just think right now, the smoother we can make this process for everybody, and I know we always wanted to keep it smooth, but let's make it even better because it is a little bit more stressful because they are making a little bit higher payments. They're, different things have changed in the market. So let's walk them through the market a little bit and maybe be cognizant that it could help their experience, but it can also help them give you more referrals when you bring them somewhere. So.
Right.
And on the same topic, could the homeowner, if they have the relevant knowledge, could they be approved to do some of that renovation on a renovation loan?
None of these allow self-help.
Is there a time frame for an FHA 2 or 3H? What if the disaster area was declared a couple of years back?
It still has to be declared at the time. So it still has to be a disaster area at the time to be able to do it. I had people that were in Florida that were asking me about Hurricane Michael. It has to be a current declared area. So you can't go back years ago, unfortunately, and pick it up.
How do they qualify for income if they are changing jobs from Florida?
It's kind of interesting. And when I took the class on this, they were even talking about they'll work with people. Obviously they have to find a job in Georgia. Obviously they have, but they don't necessarily have to start it. I mean, they're going to not be as restrictive. For instance, like on tax returns, what if all their tax returns were destroyed? So instead of having to provide them, they're going to allow us to get transcripts from the IRS. So they are going to give a little bit more lenient on this because they realize what people have been through.
Would a client have the ability to use this in the same state of that disaster? So they wanted to buy again in Florida.
Yes. I just brought it up because I wanted y'all to know why I put it on here, since it kind of seems stupid, and so that it works in any state. I didn't want you to think that it could only be somebody staying in Florida and it happened in Florida. But they could buy in Wisconsin, they could buy in Alaska, or wherever they want to buy. How
and where can we verify PDMDA?
I have a list. If you will email me, I'll look it up because it has to be on the Fairway list. I don't know another way to do it. I'm sure there's a website that says what it is, but I can also look it up on the Fairway list for you if you'll email me an area that you want to know, or I can maybe cut and paste it for you. Now that we're in this world of rates getting higher, all of the FHA and VA loans are assumable. And I just think it's an amazing opportunity for buyers, for sellers. It works for both sides, that these loans are out there, and some of these are in the 2s or the 3s, or, there was one that was an example a while back that was a solid source agent that had a VA house that was listed that was at 2.875. How you qualify for a loan assumption is determined by the servicer of the loan, okay? But it's going to be the same kind of guidelines as if you're qualifying for a new mortgage, I would assume. It used to be a little bit easier, but it is qualifying now. So they do have to qualify, but the good part about that is that they are going to release the seller of liability. The seller needs to make sure that they are getting released, but they should because they are qualifying that buyer. So what this buyer can do, if you find a listing or you have a house that is listed and it is an FHA or a VA loan, have your seller contact their lender and make sure that their loan is assumable and see if they'll give you an assumption package. Because in that package, it'll tell you exactly what is required to assume that loan. And it'll say what documents they need to see, what they need to qualify for. And then that buyer can assume what the mortgage is. Now, where it's going to get a little bit tricky is that, let's say if they have a loan that's a little bit older and they've paid the house down a lot, or it's worth a lot more, then obviously that equity is not assumable. It is only the mortgage, what is left. And it's the current rate of whatever the seller has on that house. So either the buyer is going to have to come up with a cash difference between the sales price and what that loan is, or the seller may want to hold back a second because they can do that on assumptions. You know, there's not the hard stops like there are on a regular loan. But I think it's a great way for buyers to find a home that maybe is in those 2 and 3% rates and be able to buy it and get the home that they want without having to worry about what the rates have done. And I think this is a great way too to market a house for a listing agent, just to let them know that the loan is assumable. Now, they may not use the assumability, but it's also going to get people to call on the house and ask questions about the house when it's listed. Here's the thing on VA, and I don't know if people know this. VA has what they call bonus entitlement. Okay. So if they assumed it, and I don't know 100% on this, but if they assumed it, my mind is thinking it wasn't in default or anything. The people qualified for it. And if they're released of liability, they should be released of also what they owe as far as their entitlement. Okay. But even if they held it as an entitlement, people can go and buy a second house with a VA loan, because I've done loans for people that, let's say they got foreclosed on and they lose a certain portion of their eligibility, but there's a formula that you can do in order to find out what they can buy still, because they still have some entitlement left. Now, they may have to put a little bit of money down, but they still have that ability to do it. And then there's a way that you can calculate what's their highest loan amount that they can do without putting money down. So as far as the loan assumption, I just feel like if they're releasing them of liability, why would it still stay on their entitlement? But if it did, worst case scenario, then you do have the bonus entitlement. Recasting is once you have closed, this is something that you can do in order to lower your payments. Okay. Everybody thinks about refinancing. And I know I'm a loan officer and I know I make money on refinancing, but refinancing, you're paying so much money to lower your rate. By recasting, let's say you have a bonus or something that you get, or you had an additional commission, or you sold a house that you didn't sell before you buy it. You can go in and put down, let's say $100,000, $50,000 or whatever to your mortgage and have them recast it where you keep your same interest rate. But what you do is they will re-amortize it over the life of the loan. So if you look at this example on the bottom, if you had a $500,000 loan amount, when you start, the principal and interest is $2,684. If you did a one-time principal reduction of $100,000, it would now take your payment to $2,149, but you wouldn't have all those closing costs. To recast it, it's usually about $300, but you can only do it one time with most lenders. It is up to the servicing company when they will allow it, and if they will allow it. And they will not do things for like 5,000 increments, okay? It's going to have to be a chunk of money. It's going to have to be, you know, 50,000, 100,000, a good chunk of money that makes it worth it for them to do it. But it's a really good option for your customers that, again, they don't want to sell their house before they buy a new one because they don't want to move twice. All their equity is tied up in their current house. They want to put some money down, but they don't really have enough to do the 20% to get rid of mortgage insurance or even more than that. So this is a great option for those people to let them know, instead of doing, let's say, a bridge loan or something like that. I have never done a bridge loan, but everything that I've read on them, the interest rates are very high because they're short-term loans. I've read that if you pay them off in a short period of time, you could also have a prepayment penalty on them. So this is an option to give people without having to pay interest on their money that they're really borrowing, but they can use it and still put it into the home to lower their payments.
Does it recast for the amount of time remaining on the current loan, or does it start a new clock for 30 years?
It recasts on the current. So if you do it 5 years down the road, you're now on a 25-year loan. So it depends on when you do it.
And that is a big chunk of money. So that's not for everybody, but
it's not for everybody, but I've had it asked several times lately. and mostly in the situation where somebody doesn't want to sell their house. Yeah. Eric sent me an email yesterday and said there were a lot of questions as far as how much a seller can pay towards closing costs, because we're getting back in the market now where the sellers are going to have to pay some closing cost. So what I did is I broke down here And it's real funny because everybody thinks, 3%, I mean, that's the norm and everybody thinks that. But as you see, FHA, they can pay up to 6%.
Wow.
So if I were a listing agent, or even a selling agent, and I have a buyer that's going to go FHA, I may think, maybe I'd rather pay a little bit higher price and get them to pay more closing costs, because then now I can not only pay closing costs and prepaids, but I can pay my rate down. We're in a different market. 6% is a lot of money. And you think about what that can go towards. VA is 4%. But if you notice, VA does not go by the sales price. It goes by the value established by the appraisal. Okay. USDA, 6%. Now, conventional, and nobody ever really talks about this, but conventional depends on how much money the buyer is putting down. So if the buyer puts down less, or their loan to value is less than 75%, so they put down 25% or more, a seller can pay 9%. Nobody thinks about that.
Mhm.
They think 3% all the way, and you don't think about it. And I don't think about it either. So I'm putting myself in this category. Okay. So if you're greater than, or you're between 75% and 90%, they can pay 6%, just like FHA. So if you have a buyer putting 10% down, seller can pay 6% towards closing cost. If you're putting greater than 90%, though, that's when we get the 3%. And I think we just got in a habit that was the easiest one to go to, because that was the norm. People are not putting down as much. But now when people are selling houses and they have a little bit more equity, they're putting more down. And we need to think about that. And also too, like I said, not only are you going to be paying the closing costs, but you can, whatever the seller says they're going to pay, you can guarantee myself and most loan officers, I would think, we're going to use every penny of that, and we're going to benefit the buyer the best that we can. And if the seller's still netting what they wanted to net, then who cares? So maybe you price a little bit more, knowing your seller's going to have to pay a little bit more. Now, granted, you have the chance that they may not, but still, I mean, you might as well try. Investment property, though, if you are buying an investment property, the seller can only pay 2%. So it is a huge difference. So keep that in mind. Now, the note that I have, you have the LTV and the CLTV. The LTV is the loan to value. So that's how much they're putting down. Let's say this buyer is going to take a second. Okay. That's the CLTV. So if somebody is taking out a second and that puts them above the 90%, now they're back to 3% instead of, let's say, the 6% down that you can do. So you have to be real careful. It's not just that first mortgage they're doing. If they're taking out a second and their combined loan to value is one of these percentages, it goes by that.
That's a lot of good information right there. And it actually makes sense, when you break it down. The only thing, I mean, I can see maybe, the home values are still currently in a good place, right?
Okay.
I haven't gotten a whole lot of calls about issues with appraisals in a minute, which is good. Things change all the time, though. When we are going through waves of time, when there are issues with appraisals and questions about value, there might be a question at that point about, well, will the home appraise, and you got to readjust, and that's just how it is. I don't know of a way to get around that. But no, this is great information.
Derek, I'm glad that you asked this, because it made me stop for a minute and write it down. And, it's so funny because sometimes when you forget things and we do them out of habit and just say it so fast, because that's what the norm is, sometimes we have to slow things down and kind of look at it again and write it down. And we're like, oh, wow. Yeah, we got to use this. Again, though, we have to get the seller to agree. And again, in the negotiations, but you do know that you do have a little bit of flexibility. And that's just my contact information. And I appreciate it.